Today, let's talk about KRA and the taxing of bank and M-Pesa deposits. There is a lot of confusion around this topic, so let's break it down simply. Kenya Revenue Authority may treat money deposited into your bank or M-Pesa account as taxable income only when the source of that money cannot be explained. This means the burden of the proof is now on the taxpayer. When reviewing your taxes, KRA may look at your bank statements, M-Pesa statements, and how often money is coming in. They also compare this with what you declare on iTax. Here is the key principle to remember. Not all deposits are income. A deposit is only taxable if it represents income. If it is not income, you must be able to explain it to Kenya Revenue Authority. Some deposits are not taxable if they are properly explained and supported. These are some of the examples. We have gifts. These are money sent by family or friends, such as parents, a spouse, or relatives. It is not taxable income. These types of gifts are very common on M-Pesa and bank transfers. Second, we have loans received. Personal or business loans are not income, but you should be able to support them with a loan agreement and, where possible, repayment terms. Third, we have capital introduced into the business. This is your own money that you inject into your business. For example, savings moved from your personal account into a business account. 4, we have transfers that are not even income. Next, we have transfers that are not income. This includes transfers between bank and M-Pesa, all between your personal and business accounts. This is simply movement of the same money, not earnings. We have client's payment already declared. If you have already included client or customer payments in your tax return, that income should not be taxed again. Next, we have refunds. This includes supplier refunds, overpaid bills that are returned to you, and reversed transactions. Those are not income, so they are not taxable. Then we have reimbursements. This is money refunded to you for expenses you paid on behalf of someone else. Examples include maybe office expenses, travel, fuel costs, or shared bills that you paid first and you are later refunded. They are not counted as income, but you have to prove that. Then we have sale of personal assets. Selling personal items such as a phone, furniture, electronics, or a personal car is not business income as long as it is not part of a regular business activity. These sales should be occasional, not frequent. Another example, we have insurance or compensation payments. This includes insurance claims and compensation for damage or loss. These payments are not business income. So in all those examples, you should have proof to show Kenya Revenue Authority that it is not business income. Now let's talk about deposits that are usually treated as taxable income. These include business sales, meaning money you earn from selling goods or services as part of your normal business activities. Then we have client or customer payments. For example, payments received for work you have done, freelance jobs or services rendered. We have freelancing income is taxable whether it comes via M-Pesa, bank or other platforms. Then we have professional fees. They are also included in the taxable income. Any payment you earn for providing professional services is taxable. Then we have digital income, such as incomes from platforms like YouTube, Meta, TikTok, or other online content creation is considered taxable income. In short, if the deposit represents money you earned from work or business, it is income and it will be taxed. Now let's look at why many people end up having problems with KRA over deposits. First, we have mixing your personal and business money. When you use one account or one M-Pesa line for both your personal transactions and your business income, it becomes very hard to prove which deposits are income and which are not. This makes KRA more likely to question you during a review. Second, using one M-Pesa line for everything. If all your payments, whether personal, gifts, or refunds, come into the same account, KRA may assume unexplained deposits are income. Separating your accounts is much safer. Third, we have poor or no record keeping. If you don't keep receipts, invoices, or explanations for deposits, you will struggle to prove that some of your deposits are not taxable. Even small amounts need documentation if they add up over time. Finally, we have filing new returns while deposits are coming in. If you declare zero income for the year, but KRA sees deposits in your bank or M-Pesa, this raises a red flag. KRA may assume that the unexplained deposits are taxable income unless you can explain them properly. The key point is, the problem is not money coming in, the problem is when you cannot explain it. So just know that KRA does not automatically tax every deposit. Deposits are presumed income only when unexplained. Once explained and documented, they should not be taxed. This is about tax assessment, not automatic deductions. To protect yourself, keep simple records, separate personal and business accounts, label M-Pesa transactions clearly, keep evidence for gifts, loans, refunds, reimbursements, and any other we have included as non-taxable deposits. So the takeaway is simple. Money coming in is not the problem. Failure to explain it is. If you can explain your deposits, you have no tax issue. If you can't, KRA may treat it as income. Like this video, please subscribe and join the family so you always get step-by-step guides and tips that actually help you with KRA. Thank you for watching and stay tuned for my next video.